What if I told you that 82% of small business owners may have a financial problem when they retire because of this one factor? They didn't plan for, and stick with me for 10 more minutes and we'll discuss something called the asset gap. Hi, I'm Tom Perrone, President and founder of New England Consulting Group, and I've been helping business owners create financial clarity for well over 50 years so they can enjoy in the future their economic effort. And I want to welcome you to the video. So today we're going to cover something that John Brown of BEI coined the asset gap. The majority of owners base their retirement on hope and not reality. And what I mean by that is that if you ask any business owner what their business is worth, they'll gladly tell you because they have it in cement as far as they're concerned. But if you asked any business owner what they need to retire on, that's a whole different issue. Now, 82% of the business owners may not retire with a full business equity in their hands, meaning when they sell their business and pay capital gains and taxes and transfers and all the fees, the net amount ends up being a lot less than they really needed to create and recreate the way they were living while they were a business owner. You know, keep in mind, in business, so many things are really paid for you. You know, you have your car, your vacations, your lunches, your golf, everything. And when you retire and are left with a certain amount of money, that's limited, and you're earning a low rate of return because you want it safe, all of a sudden you've got to really measure that income compared to what you're making. And we're going to talk about a case in a little while. The biggest problem, though, is they find out when it's too late. In other words, I didn't do another planning. And that's where John Brown from BEI, he coined this asset gap. I thought it was a real good term because it truly is. And we're going to talk again about what is the asset gap. So what is the asset gap? John Brown coined this term so well. But the asset gap really is the difference of what you have, but what you need when you exit your business. Now, why is that important? Because if you're 10 years away from exiting your business and you have X that'll grow to Y, but you need Z, wouldn't it make sense that you would put some effort in growing the value of your business so when you do sell it, you get more value out of it to pick up the difference of what you have outside the business? Because you're going to need that amount when you add Social Security and all the other benefits. And the key questions that you should be asking yourself is the security goal that I have accurate? Do I need more or less than in reality from what I'm living now? Have you accurately quantified the resources available today? For an example, I had a business owner that was assuming 10% on rates of return on their mutual funds in the 401k, and I said, that's very high. Use 4 or 5%. Do you have an asset gap? And if you do, what's the shortfall between what you have and what you're going to need? Again, it's what you're going to need. And how big is that asset gap? And what must you do to bridge your asset gap? Now, 18% of business owners have discussed this type of issue with their planners. And I think a lot of people owning businesses are relying on hope. So their business is based on hope, not reality. Owners are living in the world of hope, as I mentioned, and not reality. And John Brown, in his book, talks about the misperception spell. And that's a great term because, again, it's not based on facts. What I think or what you think of their business or your value is one thing, but what it ends up on paper could be a whole different ballgame. And you need to get real with some of those assumptions. So there's 6 areas that I suggest that be reviewed when you're thinking about funding your asset gap, and that is the amount you're going to need after you exit your business, how long you and your spouse will live, the rate of return they expect on invested assets, the value they assign to their companies. That's important. What's your company worth? And if you're doing that, are you doing it quantitatively or are you doing just out of the blue? The rate they predict the value and cash flow, and the net proceeds they expect from a sale. This is an interesting area right here, what they expect from the sale. And this is where I think a lot of the problems exist and why we spend time really analyzing what the business is worth and projecting out. Now, here's a perfect example of a client who is in their 40s. They want to retire in a couple years. So when we did the asset gap analysis, you can see that in this column right here that he valued his business at 1.5. He valued that he need $120,000 a year. He figured he would fund for 25 years. Now remember, he's only 45 years old. He could live to 90. Withdrawal rate, he was using 7% on withdrawal. An old figure, I don't know where he got it. So he felt he was around $2 million. But when we really put some figures together and analyzed them, his business value after the appraise was pre-tax was $1 million, not 1.5. And when we did his budgeting, we came up with 200,000 pre-tax. What he did over on this column is that he didn't assume any taxes and certain things that the company is paying for that he himself would continue, but doesn't have a company to pay for it. And of course, life expectancy was 33 years because of his age versus 25. And we suggested to him he use 4%. And when we did that, what happened was we came up with $4.5 to $5 million. So the result really was a $2 to $3 million shortage of asset in this value. So what did we do? We focused on 2 things. We referred an investment advisor to him to keep his outside business portfolio going at a moderate rate. And we worked and brought in a business specialist to work with him on his value drivers to build his business, because he's got another 10, 15 years to go. He's got time to work on this. And hopefully by that time he'll have what he needs. Now, there's 4 elements of every client's journey, because it is a journey. You have the starting point, which is your business value after tax, your non-business investments that you're doing, and your Social Security. This is the base. The destination is to make sure you have enough investable assets that will carry you to life expectancy based on the assumptions that we talk about. And the distance is really that gap. You know, what is that difference that we need to get you, when you retire, the net amount of money that's sitting in a pot, ready to go at an assumed rate that's reasonable. And the map, of course, is the planning, which is the advisory team that you pick to help you out. Very, very important. In the previous example, the balk that client had was, well, now I got to get a valuation and I got to pay fees and I got to pay some people. Well, yes, you do, because no one does it for free. And, I use this term. I used to hear from business owners that my trade association thinks my business is worth X. Well, that's a rule of thumb. Nobody's a rule of thumb. And if you use that, that's blind thinking, okay? It's not quantitative thinking, it's a hope. Um, in most cases, business owners are very surprised what their business is worth, good or bad. So in Francis's case, in this example, the business appraiser charged him $2,500, and then the other planners charged, it was $5,000. But when you take a look at the fact that he was short $2 to $3 million, now he's going to have people on his advisory team that are going to review with him yearly what to do to get your business back up. So it does a number of things. It clears the misperceptions before the sabotage of the exit plan. It keeps the owners in control of their business at their timeline. That's really important because it makes them think of what they're doing quantitatively. What am I doing with my value drivers? Am I doing this? Am I doing that? Am I eliminating this? Which is really the things that create all the value for them. And importantly, it replaces assumptions with the facts. That's big. And you might have an assumption as a business owner, but your advisory team, they're being paid to tell you that sounds good, but it's wrong, right? And it puts the upfront cost in context because I'm only spending $5 or $10 or $15,000, but I'm able to build my business up to $3, $4, $5 million. There's a big difference there. It motivates owners to act sooner. That's the big thing. The big problem is they get to know it. They get 2 or 3 years before they retire. It's too late. It's too late. You can't do it. Many of the business value drivers that we talk about in growing a business need years to implement. So this information is so important to know well in advance. Well, I've given you kind of the highlight of the asset gap, and I have a report that if you look in the description, you can download a report, the gap, a report by John Brown. It's very good. There's another download you could have, and there is in there something called the Business Owner's Viewpoint. And I use this, it's a 3-minute survey. I use it with people and business owners. And what it does in three minutes, it kind of gives you an idea of where you are. You can't do future planning unless you know where you are. And a lot of us have done planning, put it in the drawer, haven't touched anything, but things come out of Washington, your personal life has changed, your business life has changed. So what you did 5 years ago is probably out of date. And if you've done a plan prior to January 2026, your plan is already out of date because the tax law changed. And when you do that, I send you a report and a video, and you could sit in your own privacy and listen to that. And if you like this video, certainly like and subscribe. I'd love that. We come out 2 or 3 times a month with different ideas. But also check out this next video that I have, because if you're your business owner listening to this, you're going to want to know other ideas about exiting your business. And that video is all about that. So, in closing, be the exception. Review the 5 gap analysis questions often. We review them every year on our clients' review. Replace sentiment and hope. They don't have a place in planning. And your advisory team will tell you what's sentiment and hope versus fact. That's why you want them. And you want to create the best chance to exit when you want to exit, and for the money that you need to exit, and to the person you choose to run this company. So I want to thank you for taking the time. Please download those reports. Again, I invite you to take the survey. I'd be more than happy to send you a report. And thank you for taking the time to view this video.